Roger, it's great to have you, especially on a day like today. Welcome.
Thank you.
I think that my key question is, how is the Fed likely to view this report? Are they likely to look at it and say, OK, we're going to stay on our current path, or we need to do more?
I think what they're likely to do is see this, as you indicated in the opening, as being inflation across the board, higher than expected. Some might see signs of peaking, but I think it's too early to call that. My expectation is that they will do 50 next week as signaled, but I think the tone around that is going to be leaning towards a bit more hawkish. I suspect when we get to the press conference, the possibility of 75 being on the table in the future will be talked about. And so I think next week it's the 50 that's been broadcast. After that, I think the risk, so to speak, is to maybe an extra 50 or two more than the market's priced in, and possibly a 75 if called for. And I think that will be the signaling the next time they have a chance to speak to us.
Well, in terms of expectations, one thing this report did was it sort of knocked out the idea that they would pause in September, as was indicated by Raphael Bostic, the Atlanta Fed president. So now there's 50, 50, 50 priced in June, July, September. Roger, but is there merit to a pause? Because is there a risk here that we could get into a stagflationary environment where growth does slow pretty substantially and we still have these higher inflation numbers?
Well, there's absolutely that risk, which is, I think, why the pause is not likely at this stage. It would have been one thing to consider a pause if we had seen some sign of inflation peaking and coming down. And, maybe the committee would have said, well, let's wait and see if we've got clear and convincing evidence, to quote Chairman Powell. But at this stage, I think the idea is going to be they will continue to have to raise rates, maybe aggressively, 50, 50, 50, maybe a 75. Until we really get inflation under control. And that means, frankly, risking the possibility of, as Chairman Powell said, some pain. And so I think the trade-off has really got to be making sure that inflation is under control. That is job number one, number two, and number three. And if what that means is slowing and potentially dipping into a short, shallow recession, I think the Fed's willing to do that, because this inflation is really unacceptable and far out of the 2% range, obviously.
Well, and now there are questions about credibility, Roger. Today, the longer-term inflation expectations are starting to break out, raising the question of whether inflation expectations are becoming unanchored. Can you just explain why that's such a big deal to these central bankers and their credibility?
Oh, well, the whole issue of inflation expectations is incredibly important, because what happens is then it becomes easier to build in one of these spirals. You hear people talking about a wage price spiral. Wages go up, prices go up. There's also something that one might think of as a wage spiral. People leave one job to get more wages someplace else, and then their former employer is forced to raise wages. And so I think this question of inflation expectations is central to their thinking. We know that inflation is too high. We see it starting to broaden across many categories, as you talk about. We see it picking up and remaining high in the core inflation, taking out food and energy. And the last thing they want is to start to see inflation expectations become unanchored, because then households, businesses expect there just to be an increase in prices consistently, and that becomes something that's very, very difficult to deal with. So that's why I went back to 350s, maybe a 75, and to your point, they want to avoid stagflation, but they absolutely want to avoid inflation picking up. And if that means a short, shallow recession, then that may be the kind of pain that we may be in for.